fundsupermart.com.
Hello everyone. The Asian bond market has seen a huge rally in the past 2 to 3 years that yield a double-digit return for investors. Has the market already seen its best days? Today we have Chia-Liang, the head of investment management at Western Assets, to share with us his views. What's your overall outlook for Asian bond markets in 2013 and 2014, and how much upside are you expecting?
Last year was an extremely good year for Asian fixed income. So Asian bonds return on aggregate 9%. This year, I think the total return was slow, but to a still respectable 6% area. This taken into context of the high-grade nature credit profile of Asian bonds, still an extremely attractive proposition. Importantly, the way we think about Asian bonds is looking into 2013 and into 2014, that amidst a still low interest rate environment and with some structural problems still lingering outside of the region, we view Asian bonds as a safe harbor for investors, both within the region as well as outside the region, to extract value from three sources of value: local rates, currency, as well as credit. Across all three, we anticipate positive contribution from these three components.
What are the opportunities and risks you see in the Asian bond market?
Well, I guess we start off the year with quite a fair bit of market rumblings of the great rotation out of fixed income into equities. Certainly from our side, and as far as we observe from market flows data, that hasn't bear out yet, at least for Asian fixed income. And the sense that we get is that equities can coexist with fixed income just because they fit in different mandates, different risk reward benefits. And as such, we think that the great rotation could prove to be a marginal rotation where equities probably see a rebound, but at the margin, we're still seeing quite a lot of structural flows into Asian fixed income. And from our perspective, that provides us key support in terms of demand, the demand base for Asian fixed income. So from an opportunity perspective, we still see Asian fixed income as very attractive. In terms of the risks, we are extremely mindful, still a lot of uncertainty. Clearly a high-grade portfolio, a region where the government's balance sheets are improving versus deteriorating in the developed countries, speaks to potential contagion effect. The good news, though, is that Asian governments have the ability and willingness to cushion those shocks in terms of turning on the policy spigots. So we're mindful of the risks, but from our perspective, we view the risks as well contained given the strength of Asian economies.
On the currency side, which currency in Asia has a stronger upside this year?
Well, we think that currencies will play an important part this year in terms of adding value for an Asian fixed income investor. In terms of the specific names, we like the Philippine peso. We view the Philippine peso as reflecting a pretty marked structural rebound with the fundamentals, in terms of its improvement warrants a relook, a re-rating from sub-investment grade to investment grade. We anticipate that could occur as soon as in the second half of this year. So we are positive on the Philippine peso. We are also constructive on the Chinese yuan. We view the Chinese yuan from a structural perspective, and if you look at recent history, never has the currency of the world's second largest economy not play a greater role. So it could be as a means of transaction, it could be a store of value over time. We view very favorably the prospects for the dim sum bond space, and over the longer run, we anticipate progressive liberalization of Chinese markets to provide support for the Chinese yuan. And obviously, we are of the soft landing camp. The Chinese policymakers have obviously done a very great job in terms of maintaining the growth momentum, and that is unchanged and intact for 2013. Last, but certainly not least, Korean won. We still like Korean won in spite of some of the noises out emanating from volatility in the dollar yen. Now we think that price competitiveness is less a factor in terms of influencing Korean manufacturers. If you think about the technology, the degree of sophistication of Korean-made products, technology, as well as autos, the improvements in technology has been nothing short of spectacular. So it's not simply a currency play, and we continue to view the Korean won as likely to participate in a continued steady gain in tandem with the steady economic growth in the Korean economy.
What's your preference for bond duration and why?
Yeah, I think this is a very good question because clearly the scope for rate cuts in Asia will be contained, given that we've seen most of the cuts back in the second half of last year. So the only country that we anticipate that there's room to cut further is India, and Korea could probably cut one more time. But for the most part, we think that central banks will most likely be on hold for the year as a whole, which kind of brings back to your question that curve positioning would be critical. And if you look at the yield curves across Asia, for the most part, the yield curves are extremely flat versus historical patterns. And on that note, long end clearly looks rich. We view the sweet spot as residing around the belly and inside, so where we are not exposed to excessive duration risks for the amount of bond holdings that we have. So I would say the belly of the curve provides the best value for investors looking for exposure into Asian fixed income.